and an outlook for the week ahead. We're delighted to have John Deftorios back with us, one of our founding commentators, and he took a sabbatical for a year for multiple different reasons, but one that he had a day job as the emerging markets editor and anchor at CNN, which is now a former position. And congratulations, John, on your next opportunities, and chairman of the Agora Group. Welcome back. And we kick off this Sunday morning with oil markets closing on Friday, John, having reached a two-year high close, nearly getting to that $70, not quite, but ultimately there's a lot of wind in the sails of this oil market at the moment.
Yeah, and in fact, there's a wind in the sails. Sean, it's nice to be back on the GI discussion, especially on a Sunday as we kind of look back at the week that was and the week ahead of us. It's also just a commodity demand-driven push at this stage right now. So if you look, you have WTI and North Sea Brent hovering around $68 a barrel. The rig count continues to go up. Lumber prices were surging because of demand in the United States with low interest rates. And you can look across the grains and everything else. It's pretty strong. And you can see within the Biden budget plan here of $6 trillion for 2022, which the debate's just getting underway, that interest rates remain low, the Federal Reserve remains accommodative, and there's going to be plenty of liquidity around. So we're going to have this short-term burst for demand, it looks like, for oil, much above $70. I'm not so sure, because you see that U.S. production output is starting to rise alongside. And that's always this challenge for the OPEC players. Do you try to control the overall output and level this market at $65 to $70 a barrel? Or at that price, you see the U.S. producers come back to the fore. The EIA numbers last week were, indicating that demand is coming back right now. And then
a lot of quite bullish commentary out of the EIA, and then the other side of the street, we have the IEA coming out with all sorts of sort of forecasts about shutting down investment in oil production and the outlook in order to reach the sort of climate change targets. There's many headlines to pick out from last week on that, John. One that stands out to me amongst the many is the decision at Exxon Mobil, where we saw this activist fund with only 0.02% of a stake in Exxon Mobil, yet managing to get 2 seats on the board. How do you interpret that? What do you think this means for the wider industry as a whole?
Okay, good. We can break out each one of these things, Sean. IEA, Exxon Mobil, Shell for the week, Chevron with the shareholders weighing in, but let's talk about Exxon Mobil. Engine number 1 is the name of the activist group. As you suggested here, they didn't have a lot at play, but they have a loud voice. But the other interesting thing about it is that you have the major players like BlackRock suggesting the same. So they're not acting on their own, but they're kind of the front runner on this. But other major investment funds on Wall Street are saying to the major oil and gas companies in the United States, you kind of have to get into alignment with what the rest of the world is doing. I would suggest in particular the European IOCs, right? So ExxonMobil has been very slow to make this transition as the largest producer in the United States. There's no doubt about it. Chevron was one that moved more aggressively on that front. And you see now with the IEA suggesting that demand that was at 100 million barrels a day in the third quarter of 2019 is already reached its peak, suggesting that 74 million barrels by 2030, around that, and then 24 million barrels by 2050. What I found was interesting about this, Sean, is that there's alignment now between the International Renewable Energy Agency here in Abu Dhabi, which had a report out in March, mid-March, suggesting you need $131 trillion between now and 2050 to make the transition. And the numbers are almost exactly the same, suggesting that demand in 2050, according to IRENA, is going to be 25 million barrels a day. And now we see the IEA, which was founded, as you know, in 1974 to protect oil supplies because of the Arab embargo, suggesting that demand is going to drop to 24 million barrels a day. And we could have a half-hour discussion on all the other things they put in here in terms of hydrogen demand, renewable demand, and investment coming to the fore.
Sorry, do you think we will see resistance in the US? I mean, I remember a year ago, actually, we had Amos Hochstein on this channel, and actually he's going to be with us again this week as our halftime talk as the former chief Iran energy analyst for the US State Department. But in terms of his forecast, that when we're looking to Biden administration, he was sort of putting it in the context that he would be the savior of the US oil majors because they couldn't find their own pathway to the transition, and that the Biden administration would be imposing that transition on them. And now we're seeing the Senate, the Republicans fight back a little bit, some declarations there. Do you think that there will be a pushback of strength against this in the US, body politic and industry, or will they just at this point accept this change?
Well, that's an interesting way of putting it. So let's look at the politics that you were suggesting here. The Biden plan is $1.7 trillion for the infrastructure plan. He has it kind of framed as the American jobs plan. And then you saw the Republicans in negotiation this week bring that down to 928. So you do have a gap. So mind the gap. The thing that's dangerous about this, in my view, from the Republican Party, they're looking for pork barrel politics here. I worked in Washington for 5 years on Capitol Hill, and they're saying, okay, what would benefit my constituency, right? Each one of the senators or congressmen and women saying, okay, yes, we support this. So the roads, the bridges, the rail system needs to be modernized. But where we have the difference here, and that's the funding difference, is where Biden wants to take this in terms of, 500,000 charging stations for electric vehicles, right? New vehicle sales still of electric cars are rising at a very rapid pace, but they're minuscule according to the targets. And if you go back to the IEA report, if you go back to the ARENA report, Sean, it's suggesting that we need to be in the range of 80 to 100% of electric vehicle sales by 2050. There is this gap that exists in the market. So there's the aspirations of the Biden administration and the European Union for electric vehicle sales. The Biden administration is trying to put tax incentives and tax credits in to spur electric vehicle sales. And I have to say, I agree with Amos on this because they're trying to push the industry in the right direction. We also have to watch very carefully because the lease sales and the policy for oil and gas drilling is coming up under the Biden administration for review. That'll give us greater indication of what they're planning to do in the near future. I'm disappointed with the Republicans. So this is a once in a lifetime opportunity. And the other thing I would add to this is that I look at Joe Biden as almost an FDR, right? 1933 to 39 with the New Deal. Biden sees he's a one-term president, I think partially because of age, although he's indicated he would probably like to run again. But he's trying to
he couldn't signal this early that he's going to be one. Or
of course,
he would be a bit lame-ish, yeah.
Right, but he's going to give everything he's got to make his mark at least in one term. And I think this $6 trillion budget that he's putting forward for 2022 is an indication of that. He wants to put the infrastructure program in and then back it up with more pro-renewable transition policy for next year as well.
It would have been, we're obviously hoping Christoph Ruhl to join us. He's having technical difficulties in that very advanced country of Germany.
I was going to say that.
It's Wi-Fi challenges. But last week, John, and for the previous number of weeks, one of the biggest issues weighing on the oil markets is the outlook for the Iran nuclear talks reviving, which are now 4 weeks, a month or so underway in Vienna. They're to go into yet another week next week as we get closer to the Iranian elections. They seem to be making very consistent progress without yet having the kind of white smoke of completion, but all things are looking like they're getting there. What are your thoughts on that and the consequence for energy markets?
Right. Well, a great point. This is something you and I have talked about offline. Like, how do you manage Iran coming back into the market when Saudi Arabia is trying to manage expectations within the OPEC apparatus itself and then the wider OPEC plus? It's kind of been, I said, the new sheriff in town. This is the job of Abdulaziz bin Salman since he's taken over as Minister of Energy, try to keep everybody corralled. And there are challenges from within, as you know, Sean. There's some major players. The UAE is one of them, would like to take its capacity from 3.5, 4 up to 5 by 2030. They see the transition here. I mean, the senior sources I've spoken to in the UAE say that there's a 20-year horizon where the demand does hold up, and then that's all bets are off because of the uncertainty and the transition. So with Iran coming to the fore, it opens up this can of worms about the quotas that we have on the table right now. As you know, Iraq's been knocking on the door saying that it'd like to have a lot more. And then let's just look at a medium-term challenge. Sean, again, these are topics you could spend 10 minutes each on. We have to think about the geopolitics of energy and the transition right now. And a lot of people are just overlooking it. I think it's a big mistake. So if I look at Iran, which has not had the opportunity to go full barrel in terms of production, Iraq, Libya, Nigeria, Angola, Kazakhstan, Azerbaijan, these things become real issues depending on how fast that transition takes place, the policy that Europe and the United States put forward, China now back at the table when it comes at least to collaboration on the transition with the United States. The other things are a challenge geopolitically. But this is going to be a huge issue for those Middle East states and African states and a place like Venezuela. It's not prepared for the transition.
If you look at the Iran talks in the context of OPEC, obviously there's the obvious challenge on the supply side, making room for that possible 2 million barrels of oil to come back. But on the geopolitical side, on the political side in the US, do you think Biden has the sort of the political capital, as they say, as a new president, as a Democrat, to put this deal back in place? I mean, from the point of view of U.S. politics, does he have that kind of cover?
Yeah, well, that's a tricky question because he doesn't have a lot of support from the other side of the aisle. But I think if you're going to ask me if this deal will get done, it's yes. The challenge in the United States, I think, is that we're in short-term election cycles. Biden has a lot on his table, as you know. The budget is a priority, a full recovery from the pandemic. Obviously, trying to get the infrastructure net zero on the grid by 2035. These are all monumental tasks.
Yeah.
And as you know, because you've been in the region for so long, and I had a chance to go to Iran in 15, 16, and 17, they play a long, long game. And it's complex because we have the elections coming up in the next period here, very, very near-term challenge in terms of the transition in Iran. They're playing a long game. They want to isolate the nuclear plant first, and then perhaps visit their forays into Syria, Lebanon, Libya, and the like, its influence over Yemen. And this is something that's very tricky for the Biden administration. He doesn't want to give too much away, and then look, because of his allies here in the Gulf, what progress they can make on the influence Iran exerts outside of its own country.
Well, let's welcome Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy at Columbia University. Thanks, Christoph. Glad you were able to get back in. We were just talking while you were offline amongst the different headlines last week. Perhaps one of the biggest, at least the biggest number, is the U.S. budget submitted by the Biden administration of $6 trillion. I welcome your thoughts on that and any other issues you recognize from last week.
Yeah, thank you. Good morning. First of all, apologies for losing the connection. I had to change rooms. And John, it's good to see you again at the other side.
Yeah, nice to see you, Christoph.
That was a nice, gap was too long. So there are several things last week, and the US budget certainly is among them. So no surprise on the size. It's gigantic, it's astronomical, but that's of course because it's blown up by both the stimulus program and then the longer term start of the longer term investment program. One surprise, which is, so then you could say no surprise also in low expectations for inflation, so they're pretty optimistic on that. Necessarily have to project high debt, so it's a bit of a contradiction here, but no surprise, that's politics. One surprise I found, picked up by few observers, is the growth forecast. So after all these giant expenditures, they have reasonably decent growth naturally for 2021 and 2022. And then it slows down, and it is no different from the old trajectory which we had before the pandemic. Remember the fear which Biden's team and his economists and so all shared, which is that you have a long-term growth rate in the US, if you project it, it's a straight line until about 2008, 2009, when the recession hit. Then it goes down naturally because that's a recession. But when growth recovered, the slope was lower. So the growth rates were also lower. It not only didn't go back right away, it was not V-shaped, it grew slower than all the decades before. And the big fear was that COVID-19 would do the same. So first of all, there's a hit to GDP, of course, it declines. But then the question is, how does it recover? And the fear was that the growth rates would be even lower. And now their forecast, which should be on the optimistic side, is a growth rate which is roughly the same as it was before. So that's not very optimistic. And I wonder where that comes from, whether that's a recognition that despite all the money transfers, ultimately growth rates in all the advanced countries have come down.
When you see that, that outlook, and it's something I was speaking with a senior IBM executive about recently from his client base, and they're basically the investment into growth when the outlook is back to kind of fairly steady but low growth. Companies are reluctant to make capacity investment for new supply because, yes, you might have the rebound spring at the moment, but you're not going to be sustaining at that level, and it could be a sort of disincentive for big investment.
It could mean indeed that inflation turns into a flash in the pan and it's just back to low growth rates, high debt burden, and difficult to try to grow out of the debt burden without eventually reigniting inflation. It could just be that all this talk about secular stagnation, about all the different reasons why growth has come down, not only in the US, but in all the advanced economies, and why productivity improvements are so slow despite all these gadgets which we're inventing all the time. Could be that this has some truth to that, and that's where I would think we are. It's just an exceptional phase, the post-war period, and then the 100 years before, after the Industrial Revolution, and we are going back to normal times with slower growth. It reminds me of a discussion you had on China, when suddenly, growth slows down, then the inflation fear, of course, normally recedes. Now you see some people talking about stagflation again, the combination of stagnation and inflation. I don't think it's that bad, but I do think it might be a budget which, if implemented, turns out to be a flash in the pan because the underlying forces slowing down growth are stronger.
What we might also indicate again is it's the question of outlook on inflation and the question of the price of money. That if you're putting forward the budgets of that scale, John, the outlook has to be that interest rates are never going up again, because it also comes with a $2 trillion deficit. This plan, and all of that combined would indicate that possibility of living with higher inflation is the Fed are comfortable with ultimately.
Yeah, there's another side to that, Sean. You make a very good point. You re-inflate yourself out of the debt challenge eventually, right? And then ideally they see tax revenues going up with the higher tax rates on corporations and wealthier individuals. I actually was just running some numbers yesterday, and I remember covering this on a day in and day out basis, and said, okay, how much has been put forward since the start of the pandemic? With you take the budget inside this for 2022, because most of this is driven to try to revive growth, as Christoph was talking about, it's $13 trillion. I mean, I was covering Capitol Hill, but the stimulus package was $150 billion. They had a huge debate about, could you pass $150 billion? So even if you strip out that budget for 2022, it's an enormous amount of money for a GDP that is hovering around $21 trillion. It's extraordinary. So it's obviously going to have this inflationary pressure. To Christoph's point, though, you start to see the lumber prices level off. So was this an initial spurt? Oil prices are hovering near $70 a barrel. Do you expect a major breakout? I don't think so, because we see also the response by U.S. producers at the same time. But I just kind of scratch my head and say, can you really sustain this sort of level of debt accumulation and putting forward budgets at this sort of level? Should we be a bit more laser driven in terms of what do you want to get accomplished, Joe Biden? Is it that infrastructure plan you find an absolute priority? But behind all that, Janet Yellen and Jay Powell are in alignment as Treasury Secretary and central bank chief, suggesting that they think this stimulus is needed. So that we're going to get a test of this if we look ahead for the week with the U.S. jobs report. Are the job creation numbers going to be solid at this point forward? And it justifies this level of spending, because they said is the number one target, to recreate 10 million jobs that have still been lost since the start of the pandemic.
Christoph, back to the kind of immediate sense, this weekend is the infamous Memorial Day weekend in the United States. We're seeing very big numbers on travel, 2 million passengers now on airlines, which the pre-COVID, I think the peak 2019 was 2.6. So we're now up to 2 million. Of course, it's a holiday weekend, but ultimately, all of those numbers seem to be, reaching beyond maybe even expectations. Your thoughts on that and the outlook for the markets that will trump the weakness that we're maybe seeing in places like India and Japan, which are still dealing with COVID?
I think so. I think what we said weeks ago, that we are now sort of on a diverging but still overall path of recovery is still correct. In the US, as you said, I just looked at the same numbers. It's now 20% below 2019 levels air travel. But that was 2.5 million in 2019, the same Memorial Day weekend, sorry. And then it went down to 300,000. Now it's back to 2 million and still growing. We have now new regulations in the European Union. They're trying to sort of take over again from individual countries in regulating travel and making it easier. We have the end of lockdowns in a number of big economies, from holiday destinations like Portugal all the way to Germany, where I'm sitting. So it is looking up, and there are outliers in other countries where it's still slowing down, mostly because it's mismanaged, places like Brazil, where it has to be mismanaged because there's no capacity in places like India. On oil markets, there was indeed another big number last week being published, other than the US budget, and that was the US oil supply increased by almost 14%. And that was back from March. So what happens here is pretty obvious. It's what many people have waited for, which is the resurgence of private sector, aka shale production in the US. These were March numbers. Now, we had prices hovering around 65 since March. So we should not expect that growth to sort of have disappeared in April and in May when the numbers come out. And I think I'm with John on that, as you know. So I don't think we will see a big price spike or a super cycle. So there is a distinction which needs to be made between oil prices, which are driven by politically motivated supply constraints, and therefore now, as long as the supply cuts hold, dependent on demand growth, and the rest of the commodity prices, which are running hot because everybody all of a sudden faces bottlenecks and wants to build, and because of the energy transition, everybody wants to have copper, and there's a bit of froth in that market. But whatever you think about, whether it's inflation hedging or froth in the market, so the other commodity sector is a bit in a different place from oil markets. So in oil markets, we will see the supply response now coming from the market side, which has been suppressed so far, and that will block at any durable increase over and above certain current levels, I would think.
John, we have OPEC meeting yet again this week on Tuesday for their monthly meeting. How do they read this market? They've given us forward guidance through July. Should we expect them to start to give forward guidance beyond July? Is there a window for them to add even more barrels?
Yeah, I don't think there's any benefit to OPEC to unveil those cards yet, Sean, in my view, because of the uncertainties that we have. And I agree with Christoph on this. I remember doing an interview with Tony Douglas of Etihad just a couple of months ago, and he said every indication is when we open up a destination, as CEO of Etihad, he said it's like a fire hydrant. That, the demand is so pent up that it's just gushing out. But I don't think this is long term. I think it's just that people are really frustrated. That's what you see with the Memorial Day weekend in the United States. Talking to my immediate family as well, they're saying they're just itching to get out. So whether it's driving or flying and the rest, they want to move. And I think we're going to see the same thing in Europe, depending on how much we see the openings in certain markets and how cautious people will be.
There is forecasts that, we've got Goldman Sachs in the bag saying $80. We've got forecast of getting close to 100 million barrels a day of demand into the third quarter, if indeed all of this aviation fuel demand does come. And yet OPEC still has 6 million barrels on the sidelines, even after July.
Well, OPEC has 6, and the shale guys have 2 when you count back to the numbers they used to produce. And that's just the starting point without looking at Iran and Libya and potentially Venezuela. We have an abundance of oil supplies, full stop. Basically, without disruptions, it comes out of our ears. And so market prices would be a lot less than what we currently have. And as long as that is the case, it needs some extraordinary events to keep the price where it is.
But does it come to a point where, I mean, John, your thoughts on this, that OPEC have to think about market share? Why allow shale to come back, take 2 million of this market opportunity when they could? Yes, they might lose a few dollars on the barrel, but ultimately it's a risky moment now as we come out forward. This next 2, 3, 4 million barrels of demand, why would OPEC Plus give that up?
Yeah, and that's the argument that's going to be made to Abdulaziz bin Salman, right, who's kind of been the de facto torchbearer for restraining that production that you and Christoph are both talking about. So this is a very tricky window, and we know the pressure from within OPEC itself with some of the major players, and the same thing with Russia. They haven't hid their disdain for carrying this on for too long and giving up market share. And I also, I mean, Sean, because Christoph wasn't involved. I'd love to hear Sean's views on this as well. I mean, we're talking about an era where the IEA suggests we don't need any additional exploration whatsoever. Right? I mean, it's quite extraordinary. We're having a debate about OPEC holding back or putting back on to hold on market share in the immediate term. And then you have a horizon where people are saying, we just don't need you to explore anything else. It's an unusual period in history, no doubt about it.
Yeah, Christoph, you didn't get a chance to weigh in on that comment earlier. The idea that Exxon Mobil got squeezed this week, Shell got squeezed, and then the IEA report.
I think we're in for some troubled times because we are making a lot of mistakes. The first thing is what I take from the IEA report is what sensible people have been saying for ages, which is this energy transition, keeping temperature rises to 1.5 or 2 degrees Celsius, even if you believe in the ability of scientists to translate emissions into straight line temperature rises, is not going to happen. It's not going to work. It's too difficult. I think that's driven home very well, but maybe unintentionally, but that's what the report actually says. The second is, if we believe we will continue to rely on oil for a while, and then at the same time push the existing Western oil companies to move into wind and solar and to switch them, number one, we will be dependent on oil from state-owned companies in producing countries. Number two, we will see Western companies selling their assets to others who are probably not as environmentally conscious, so the benefits are low. They're not disappearing with the disappearance of a company name. Many of these companies down the road will probably split in an ugly part which makes money and produces oil and gas, and a sacrosanct part which doesn't make money but produces wind power, and being a bit cynical. And number three, if we are globally in a situation where there's too much oil in the world, the current exercise between OPEC Plus and demand will end in tears, in my view, in the sense that prices will have to come down. And one part of the OPEC Plus arrangement, the plus part, the Russia part, is much better prepared for this than the other. Russia's financial system now really, its fiscal system is a fortress. They have accumulated a lot of money. They have lowered the cutoff price of oil on which they depend to $42 or something, and that's solid numbers. So they can go all the way down. This is why they are a bit more careless than Saudi Arabia and others. Saudi Arabia, as John said, are trying to hold the line, and they're trying to do what they always did, and they're doing it very well this time, which is to constrain supply and to release it peu à peu in response to the durations of demand, which overall increases. But the private sector is coming back, and there's no hiding of that. And so therefore, the current price level will not be sustained. And now the last point I want to make, what comes out of this, when you step back a little bit, is for the first time in my view, the danger of a real bottleneck, that nobody does any investment anymore under those circumstances. So that not tomorrow, but 5 years from now, we probably discover, A, surprise, surprise, we still need oil, and B, surprise, surprise, nobody has done any investments in the current climate.
Yeah, I don't think there's any route forward on any of this that doesn't see $100 oil in the 2020s. But let's get the survey question in to give the room a view and just get a quick comment from Christoph and John on the outlook for the week ahead. But this question about what should OPEC provide outlook for supply beyond July when they meet this week. Analysts are forecasting that demand could reach up to close to 100 million in the third quarter if indeed we see all of this summer travel. John's going to be going off to Greece soon, using up some travel aviation fuel there. All of us hopefully will do a bit of it. But Should OPEC provide outlook for supply beyond July when they meet this week? That is the question. Should they provide outlook? John, you indicated earlier it might be premature. My argument to you would be OPEC should provide outlook, if for no other reason but to scare away the shale people deciding or not whether they're going to put $1 billion down a hole in West Texas.
That's interesting. Yeah, no, it's good. I would maybe nuance my comments that I made earlier. I wouldn't give my cards out in terms of how quickly we're ready to respond if I'm in OPEC Plus with extra production. I think it would be extremely wise for them to kind of lay out the tea leaves where supply and demand is right now, and that they're prepared to meet the needs. That's all you really need to do here, is to kind of lay out the groundwork and say, this is what we expect in the third quarter. We believe it's going to be sustained in the fourth quarter or not. And yes, we're prepared to supply crude if necessary. So as Christoph is suggesting here, to protect their turf, if you will, and when it comes to market share. So, but this is a nuanced game, because if the Saudis don't manage that process well, the expectations from within, the pressures from within also come to bear as well. And yes, Sean, I have to go to Greece, but that's the layover to get to London. So I'd rather do one hop, by the way. So I'm doing a 10-day sit in Greece. So in terms of demand, yes, I'm doubling demand because I got to go to 2 stops to get to London these days because of the red list.
That's how COVID is delivering energy consumption by forcing us all into these distorted travel journeys.
Geez.
Christoph, the other big data point in the coming week, obviously welcome your views on the OPEC question, but also non-farm payrolls. John mentioned it earlier. Last month when it came in April, the expectation was 250,000 jobs created, or 1 million jobs, ended up being 250,000. Your thoughts on how important is that data point to sort of give direction for this economic recovery?
Different questions, similar answer to what John said. It's a matter of nuances. You have to treat these job creation reports with caution, because as we discussed previously, what happens in the US is that people drop out of the unemployment statistics pretty fast when they don't receive money anymore. That's why everybody looks at this job creation number going up and down, because it reflects what actually happens. And in this case, we had lower numbers, but it wasn't meaning that everybody was already employed. It basically meant that there were a lot of women dropping out temporarily of the workforce because there was no summer camps available. They had to deal with their children, and Corona for children isn't, the post-Corona age in terms of everything open wasn't quite there yet. So in that sense, if that explanation is true for the weak numbers last time, I would expect a stronger number this time. What is probably more relevant is that a number of big economies in the European Union will also publish their, in this case, unemployment statistics next week. And that should give us a better handle for the EU, because this is very strange. When I yesterday went to the village nearby for the first time, the restaurants were open. And so here, everything seems to be in short supply and subject to some bottlenecks, one or another. But at the same time, of course, everybody complains what a terrible economic crisis, especially on the service sector, Corona has inflicted. So once with those, some of these numbers are coming out, we probably get some clarity. And that will be important to assess. The European Union is one of the biggest economic areas in the world, to assess future growth in employment and, of course, travel prospects there.
Let's get the survey result and give John the last word. Should OPEC provide outlook for supply beyond July when they meet this week? Yes, 65%, no, 35%. John, the other reality, of course, as we talk about this sort of bionic growth recovery in the US in particular, in Asia, we're seeing the announcement of total lockdown in Malaysia. India still, major cities in lockdown. There is still this COVID challenge out there to play each week, and the Olympics in Japan as a kind of sentiment of that. Your thoughts on what a factor that is for the outlook for markets?
Yeah, a fantastic point to finish on, actually. Think about it, right? The World Economic Forum delayed the annual meeting. Then they're going to try to do it in the spring. In Singapore, delayed it to August, and then they had to cancel it, right? So this is very hard in terms of trying to lay out capital investment, as Christoph was suggesting, when you don't know the ups and downs of what we're going to be faced with for the next, I think, realistically, 12 to 18 months. I know you have really good data collection here in the UAE. We have the advantage to be able to speak to health authorities. they're kind of planning 2 to 3 years of ups and downs, right? On the worst case scenario. So Sean, this directly feeds into oil demand. So I agree with our consensus here. 2/3 suggesting, yes, let's give us some guidelines in terms of what you're willing to do, what you see for demand. But is that demand a straight line up in 2022 with all that spending from the United States still in the system? I'm not so certain, the influence of India. And if you look at the COVAX distribution, I've been involved with this with UNICEF and DP World and chairing different roundtables on it. It's still pathetic, honestly. We're still going to have a challenge in markets like Malaysia, Indonesia, many, many parts of Africa. We don't see data coming out of there. Most of the countries in Latin America are not getting clear lines of it. We have protests in Brazil today, as you both know, because people want to oust Bolsonaro for his very poor response and being a vaccine denier and even a COVID denier. So I think there's a lot more uncertainty in the system. And then I go back to very seasoned hands of like Yellen and Powell, who are pretty hawkish, if you think, on economic policy. And they're like, no, let's pull out the cannons and keep on firing because we need to make sure this is sustained. It's a once in a lifetime challenge. That's the can Biden's carrying to Capitol Hill right now. Spend more. And I don't think we'll ever see it in our lifetime where the US is willing to spend at that level over a short window of time and then try to reform the tax system to raise corporate taxes, which are not extraordinarily high. But it's almost becoming like the German social democratic state, Christoph, in my view, with what the Biden administration is trying to re-engineer here.
But being the US, the guns are much bigger, and therefore the risks are much higher.
The printing presses are obviously quite large, and that's where that's going to go. It just seems, only one way that can go is that you keep printing to keep printing, because you've printed so much yesterday, you got to print more tomorrow. But that's a bigger arc of time. John, great to have you. I hope by the time you get through your burden of being in Greece to do your quarantine, that actually you'll be allowed back into the UK, because there is the question of a Indian variant disruption to the UK plans of opening up. And that's part of this, as you mentioned, part of this challenge of coming out of the COVID is that there are 2 steps forward and always, it seems, a step backwards.
I know.
Christoph, thank you so much as always for anchoring the Sunday show. Great to have everybody. We'll catch up to you in the coming days. All the best. Thank you.